My name is Jacqueline Yee, CEO of Funderbeam Exchange. Delighted you could join. Global veritable sources such as CB Insights, McKinsey's, The Institutional Investor, Frisian, Collar Capital, Setter Capital, and various PE and VC newswires. Such sources being generally accepted as domain knowledge experts to which global startups and investors reference. So I wanted to kick off by sharing with you some interesting facts and insights on the rebound in private markets in 2021 and how that might shape the alternative investment landscape in 2022 and beyond. Q1 2021 started a trend where for every consecutive quarter, right through till end of March this year, more than 100 unicorns were born each quarter. So in 5 consecutive quarters, the numbers of unicorns literally doubled to what we have now of 1,070 unicorns globally. As at the end of Q1 this year, the total market valuation aggregates to over $3 trillion. Where are these unicorns? 52% are in the US, next is Asia at 29%, then Europe 13%, Latin 3%, Canada 2%, Australia just under 1%, and Africa just under 0.5%. As you can see from the slide, together, Asia and Europe contribute 42% of the unicorns. This is why we at Funderbeam are focused on this combined region, which we together, its heterogeneity provides good breadth and depth of market in terms of diversification and liquidity pools for both sides of our marketplace, the sell side issuers and the buy side investors. So let's have a look at global capital flows. How does this massive growth and geographic distribution impact the private capital market supporting the startup and venture space? As we can see, 2021 clearly indicates that private markets have bounced back from 1 year of suppressed fundraising and deflated deal activity due to the pandemic-driven turbulence. According to McKinsey's, at the end of 2021, the total global AUM, asset under management, was just under $10 trillion. As is evident from the graph, total global funding is increasing. According to data from Pregen, deal values in venture capital category are increasing. CB Insights reports that median company valuations have risen in 2021 to 2.6 times from 1.8 times in pre-pandemic years, but deal sizes remain fairly stable at $15 million. So the increase in global funding is driven also by increased activity. From 2016 to 2021, the 5-year CAGR, compound annual growth rate, for funding is 6.3%. The COVID lockdown year of 2020 decreased funding volumes minimally by 15%. The volumes were recovered by 2021, with growth in funding increasing by 20%. This indicates that private market funding for startups and private companies remained active, albeit dampened during COVID. What was this activity? It is a mixed composition of growth startups who remained agile, either pivoting or were able to access and monetize alternative revenue streams, and new and more startups who are raising more funding rounds. In the last 3 years, the highest numbers of exits were via mergers and acquisitions, ahead of SPACs and IPOs. So companies are preferring to stay in the private sphere longer, where there is sufficient access to capital and resources to enable their growth and alleviate the need to seek a public market IPO. So what is the makeup of this private market pool of investors? The top 3 comprise VCs, who lead the pack, contributing 30% of the liquidity pool. Then it's 10% by asset and investment managers and 10% by corporates. Interestingly, angel investors contribute 9%, and according to research data, they are the only category of investors in 2021 that didn't reduce their deal size, the median value of $4 million. These investors who reduced deal size the most were asset and investment managers. Their median deal size fell by almost 50% in Q1 this year, as these active asset managers rebalance portfolio allocations amidst current changing macroeconomics and geopolitics. According to Pregen Insights, Venture capital reported a record year in 2021. Total capital invested by fund managers reached $476 billion, performance breaking records, exits soared to $410 billion. This means that VC, as a growing asset class, is proving to be a vital component of institutional investor portfolios. As institutional investors search for yield, VC is an alternative asset, offers, as evidenced by the short-term returns, an attractive risk-return profile, diversification, and potentially high upside for portfolio strategies. So with private companies remaining private longer, what is the landscape for these later stage alternative assets? What would related secondaries transactions look like? And what would return on capital for investors look like? 2021 is a milestone year for secondaries. Over 2020 to 2021, the secondary market volumes raised past $100 billion mark to reach $143.4 billion at year-end. Secondaries transaction volumes in 2021 more than doubled the volumes the year prior. 2,335 transactions were executed. Average transaction size was $61 million. If we look back into history, in 2002, the secondaries market was just under $2 billion. This means over the course of 20 years to 2021, the market expanded 75 times in size with a CAGR of 26%. Why is this growth in secondary markets liquidity significant, you might ask? Typically, for equity investments in private markets, investors commit capital to VC or PE funds for the duration of 7 to 10 years or more. This requires patient capital, locked in for a decade or more. More often than not, investors do not earn annual dividend cash income in these private equity investments. Their return on capital is long dated, at maturity, and is purely reliant on capital gain from value accretion. During the 10-year duration, investors' situations can change over time. This creates for the investor a need for early liquidity. This means a healthy and liquid secondary market is important. The secondary market is the conventional way LPs and private investors are able to liquidate their equity stakes in private companies and exit early from their private capital investments. So let's go back to the graph. Over the course from 2002 to 2020, the 10-year period of 2009 to 2019 produced the most significant 10-year CAGR of 24.3%. The 2020 COVID lockdown year had a notable impact on secondaries volumes, shrinking the market by 32%, i.e. a third. The rebound in 2021, the milestone year for secondaries, has remedied this 2020 laggard. So the 12-year CAGR from the period from 2009 to 2021 is now back up to 25%. As can be observed empirically, the secondary markets yield relatively better results, as it is a market investing in later stage startups and private companies that have not only de-risked the early stage risk return volatilities, but are on a positive growth trajectory with more favorable betas typically. According to recent research by Setter Capital, general age of assets coming onto the secondary markets are around 6 years maturity. VCs remain prominent in secondary markets. VC secondaries increased 154% in 2020 to 2021. The most active sellers were GPs of direct investments. And it is interesting that the most active buyers were funds. We see in the market VCs setting up continuation funds to roll over high conviction assets, continuing their support to their portfolio investees, which tend to reflect high growth late stage startups and private companies staying private longer. Per data in a graph from 2016 to 2021, the 5-year CAGR for secondaries is 31.1%, which is a significant 25 percentage points higher than the 6.3% CAGR for fundraising, as we saw in the previous funding slide. So will the secondary markets rally continue into 2022? What is the outlook going forward, and where are the opportunities? Let's have a quick retrospective overview of 2021 secondaries. In 2021, a quarter of the secondaries transactions came from Western Europe, and North America dominated over half the volume at 60%. The relatively young secondaries market in Asia picked up 7%, with the remaining 10% coming from the rest of the world. On the sell side, in 2021, direct investing GPs and pension funds were the most active sellers. Their combined sell volumes made up 61% of the total volume for the year, GPs at 38.3%, and pension funds at 22.2%. The forecast by Setter Capital Research indicates this pattern will continue in the 2022 year, this year. On the buy side, in 2021, the volumes of assets purchased were fairly evenly distributed, with funds taking 51% and PE directs assuming 49%. Most active buy-side profiles are secondary funds. They dominate the market at 88%. The average gross multiple for deals completed in 2021 is expected to be 1.45 times. Based on Setter Capital Research, it is expected that buyers will commit to broadening their secondaries focus, particularly in alternative investments such as direct secondaries. Strong indications of this sentiment was reported in a survey by Setter Capital of active and regular buyers in secondary markets. In terms of target IRRs and multiples, according to the said research, for VCs and PE directs, their targeted IRR on secondary purchases are 20%, and targeted multiples are 1.83 times for VCs and 1.96 times for PE. The secondary markets continue to hold promise as private companies stay private longer. For startups, although CB Insights data indicate that startups reach unicorn status on average 5 years after first funding, one has to put this in context. This is a statistic of the average. The reality is that each quarter, tens of thousands of startups are born and only 100 or so unicorns birth. So as a final note, food for thought, if we consider the macroeconomic drivers of monetary policy tightening with the hawkish tilt, which now seems more permanent than transitional, coupled with efforts towards normalizing demand and supply side dislocations, and the ongoing geopolitical vulnerabilities, the confluence of all of this, which one could surmise as potentially factors favoring more activity in the secondary markets in 2022. Interesting times. Well, I hope you have found this global private markets overview informative. We are very excited and we have a very interesting lineup of Funderbeam highlights and updates to share with you. So please stay tuned and enjoy our program. Handing you back now to our lovely Yannicka.